Hello and welcome to Your Business, Your Wealth, Sound Financial Family. I'm Paul Adams, founder of Sound Financial Group, and I am joined by a man many of you know by his legendary, mostly a beard that he sometimes has. Corey?
Wait, I've had it for like 6 months. How do they know? And you're calling it mostly a beard?
It's almost a beard. It's really nice. What you're working on?
What is yours? Like nearly a balaclava? Like, I don't know.
Yeah, it's pretty close. It's pretty close. Well, it's like the guy at the gym that can bench press 400 pounds and he looks at what I can do. He's like, that is cute. Same thing. And you have a very cute beard.
Look, it's like a lot of maintenance to buy an airplane and get a pilot's license and do all that. And sometimes you just want to go for a cruise. Like, I just want an ultralight. Like, that's all I'm after.
That's all you need.
That's all you need.
So, guys, we have a fun conversation today. And one of the things we're going to cover are some regulations that have developed out this year having to do with rolling over 401ks to IRAs. Now, we're going to have some fun because we're going through an article that kind of talks about why this is important, the new regulation, and how it protects consumers, etc. And what we're going to see, I think, in this article, to give you guys a little bit of forecasting. I'm going to do a little bit of philosopher stoning, whatever you call it. I'm not going to stone any actual philosophers today.
You're turning lead into gold? Like what?
Yeah, we're going to, alchemists. We're going to do alchemy. No,
Yeah.
What we're going to see, though, is where the financial industry tends to focus so narrowly on just one thing. And it really comes from the sales background of the financial industry and the way that they tend to focus on a product and focusing on that single product. They oftentimes only make comparisons of this is good versus this one just because of these two things being compared. But the problem is that your financial life is an entire ecosystem of different financial decisions, and so often these articles leave that out. So that's what we're going to dig into today. Corey, anything else to prep our crew before we jump into it?
No, I'm excited for this. The headline of the article is The Hidden Costs of IRA Rollovers. Subtitle, higher fees can significantly eat into returns when investors move out of their workplace plans. And, right away, it is kind of a truism. Like, yes, if you are moving to a place with higher fees, that will change returns. Great.
Then there's Paul Harvey and the rest of the story.
The rest of the story. That's right.
Dated myself. For anybody under the age of 50, I was a very old young man, so I listened to Paul Harvey.
And there's research that this article is citing from Pew Charitable Trust that find that if investors are moving money from a 401k plan with low fees to higher fees, that can change the outcome. And that is true wherever you go. And the question we're asking is really the question that has been asked all along and should always be asked: what produces the net best situation for the consumer?
Indeed. And I saw this one line that got my attention, but one thing is clear: the decision can be very consequential for your investment outcome, mainly because of fees. And that's going to speak to this idea of the micro focus of the financial industry. And we'll see more of that in a few minutes. So this is part of that study. The review found that annual expenses for median retail shares were 37% higher for hybrid mutual funds holding both equities and bonds. It was even higher at 41%. So what they're saying is your fees can be higher if you go from a 401k to an IRA. Now, most of the time people are doing that. They're doing it because there's now an advisor involved. Meaning, hopefully somebody's now getting advice from somebody else, because I don't know about you, Corey, but for the most part, out in the marketplace, we don't see a lot of people who say, yeah, I rolled it to Vanguard, now it's in my IRA, and I did that 5 years ago with my 401k. Or if they did it with one a long time ago, and now they've got four 401ks with past employers they're getting statements on every quarter.
I mean, they've either been a largely do-it-yourself investor that was doing everything on their own at Vanguard, and if they changed jobs, they were rolling that to the accounts they had already created, but never I don't ever have I seen someone who just left a job and was like, oh, now I need to go create a Vanguard account to roll it over. It doesn't usually happen. It's behind them like a long train on a bride's dress of accounts going back through
Yes. Yes. And so, yes, costs could be higher rolling to an IRA from a 401k to an IRA, but it's largely because we would hope you did that because you got help, like significant help with your overall planning. And this would be a good indicator, I think, for those of you listening,
Right.
is if somebody's making a pitch to you to roll your 401k to some great set of investments they have, and that's the offer they're making, meaning they're not saying, let's look at your entire financial picture, let's
Right.
get some actual planning done, if what they're doing is offering you a transaction to come from your 401k to your IRA, that is probably going to be the type of relationship that the regulators were worried about.
Yeah.
Now, the big problem that's happening, Corey and I were talking right before we went on the air, that they've been trying to sort some of this regulation out of rolling 401ks to IRAs since before 2008. So just give you an idea how lightning fast the government works. Since 2008.
Some things have happened.
But what I mean by that is this is why we've talked about on the podcast that you have to be your own fiduciary, right? Because you need to make these decisions and protect yourself. The government has known that some of this is a problem to the extent that they almost fully implemented regulation in 2008 before the financial markets fell apart.
Right.
Now, as a result of them not having that in place, if you're just bumping around out in the marketplace getting sold stuff, the government is 14 years in the wings until the regulation went in force that actually was a solid attempt to try to protect investors. So you got to protect yourself first because the quote unquote police ain't getting there for 14 years.
Right. Well, and this has been a problem for a while. Equity indexed and annuities that gave a hammer to a whole slew of salespeople in the industry that were not previously licensed to deal with anything of that magnitude. It's been around for a while. So if you've got an invitation to go get a free steak dinner and listen to a presentation, that's a sign that you're dealing with one of these situations that they are trying to guard against with these regulations. So there's lots of good that it can do. Now, by the way, I think some really great advisors use dinner seminars to get some relationships going and get their word out there. I think the thing you got to watch out for is this presentation you're hearing about a process and a relationship or about one specific product solution?
Truth.
That's
Speak
different.
it. Speak it, Corey.
Yeah.
So now to give an idea of why this is such a big deal is that there's about $516 billion a year rolled just in 2018 alone from 401ks to IRAs. Now, I love this.
A lot.
Now, this is so what I was talking about. Brokers and others in the financial services industry. Now, I'm going to pause there. The biggest part of the others, like I frankly think the regulators could have done a much better job with this if they would have said, hey, some kind of higher standard you have to clear before you put in an annuity or a front-end loaded mutual fund inside a retirement plan. I think that would have been way easier. That was kind of how this regulation started. And now what it is if we roll a 401k to an IRA, the advisor, and this is as of July 1, needs to put together a little customized letter or email saying this is why we're doing it and the advantages to you. Now, I don't know, frankly, Corey, this is just between you, me, and the Sound Financial family here. I don't think it's going to matter. I think people who put bad products in people's financial lives will just have a different boilerplate they put in that letter. That'll be, unfortunately, one more thing clients don't read.
Well, because the law, and this is regulation, the simpler and more clear-cut it is, the easier it is to enforce. But now there's going to be a lot of work of enforcement, of digging in and auditing. Are people following these things, and what does that really mean? And yeah, you know what's funny here, like this John Scott, I think this is right where we are, Paul, right? People should be aware of these fee differences. There's an awful lot of marketing encouraging rollovers, and people don't always look carefully enough at the fees. It's okay. I wish this had come to me at the very beginning of the segment, but let's bring it back now. I kind of feel like this whole article is like this other article I read that the headline is research says consumers report remodel costs more when they hire a contractor versus do it themselves. Meaning like
Which,
right?
You just need to say it again, because I'm afraid that is so funny that somebody could have been distracted for a moment in the middle of their workout set. They need to hear it again.
Right here. So here's the made up headline that I just came up with. Is just, consumers report remodels cost more when hiring a contractor versus doing it themselves. Now, of course it does. And the question is, what is the result that you get at the end? And either you do it yourself and it doesn't come out as well because you don't do it all the time, or you do it yourself, but it takes so much more time and effort to get to the same result that maybe it didn't actually cost you less to do it yourself in the end.
If your time is worth $500 an hour, however many hours it took you to do that home improvement or asset management was a real cost to your life. The only difference is it came, because your work usually isn't letting you take the time to do it. So it's something taken away from your kids, from your health, from your relationship with your spouse. And so people should be aware of these differences. And if you're bumping into marketing that says you should roll over your money without some kind of process, strategy, philosophy, then you have a financial salesperson, probably not an advisor. Now, which I want to speak to that briefly. So you have, there are folks called financial advisors. We are one, and that means we have a certain license. We are either a registered investment advisor or we're an investment advisor representative. That's it. And you can be considered an advisor and still not really do coaching and advising of clients. You're still just sort of selling, roll your money over to me. And so it's good for everybody to get a scope of difference between the two, because an advisor and coach should really be looking at your entire financial picture, helping it all be more efficient, not just looking at one financial thing that you have and saying, oh, we can do better than that one thing you have. So now this is funny. Fees are rarely a motivating factor in rollover decisions. For the most part, people...
surprising. That is surprising to me. They should be a consideration every time. Yeah.
Among workers planning an IRA rollover, just 3% cited lower fees as the most important reason. Now, I will give everybody listening, I think the most important reason to roll your money out of your 401k to an IRA. And that is, for whatever reason, you're not trusting your career to that company anymore.
Right.
Why are you trusting them with your money? Because other things, I'm about to start getting tuned up, Corey. I'm just going to let it fly. What these guys write these articles don't even take into account, and most people don't know this, most of you listening may not have been exposed to this. Do you know a 401k is not required? And you can read this in your plan document. They're not required to allow you to roll your money out of the plan until age 65. The law allows you to get money out earlier. But if there's something wrong at that company, they lost their head of HR, their plan is frozen for some reason. Now, most of the problems that occurred in like an Enron or before that, Color Tile, WorldCom, is that there were these plans that had tons of money in the company stock. And those companies have gotten they've done much better at not shifting people's investments around to curious or things that have conflicts of interest, like Color Tile bought a bunch of their buildings, and a big part of the 401k's investments was Color Tile paying leases on their buildings, and then they went BK and had to let all the leases go in the 401k. It took a big hit. So they're not allowing those kinds of things much anymore. But how big of a deal would it be, or how much would you even care about fees if at age 55 you really needed the money? And if it was an IRA, you could get your hands on the money. You might have to pay a penalty, but you get your hands on it. Right. And if it's in that 401k and it happens to be locked up for whatever reason, we can't get our hands on it, we might as well, in the moment we need it, if we can't get it, we may as well not have had it.
Not right, and like that's no one's plan is to take a lot of their money out of their 401k at 55, but you have the money, you've put it together, and if you need it, you need it. If you need 50 grand for a roof on your house, otherwise your house becomes useless, and that's the only pot of money you have, then the best rate of return you could have possibly gotten on that 401k account is having it there to be able to use to keep your life together. I like these.
The examples? Is that where you're going to go next?
Yeah.
So I thought the same thing. You want to go through the first one? I'll get the second one?
Yeah, I'll do the first one. So they give a couple of examples of how this could make a difference over time. So Sarah retires at 65 with a $250,000 portfolio and switches from, and this is the words, this is a direct quote, from a very low cost 401k with total fees of 0.09% to an IRA that charges 1.44%. Assuming a 5% annual return and a drawdown of $1,000 per month from her account, she has $123,385 at age 90 instead of $161,015. So great, but that's assuming a lot of things, like you're getting a 5% annual rate of return in both cases. Well, like there's no difference in those investment accounts.
Well, and yes, and by the way, the 0.09% is the Vanguard S&P 500 right. only. And so what might have also happened, number one, if she would have stayed in the 0.09 of the S&P 500 over 25 years, I think she'd have done better than 5.
I think she probably would have done better than 5.
That is not a bond fund that she paid 0.09% for. One. Two, not only that would be, you guys may remember our episode a few times ago on the volatility buffer. Well, what if all the advisor did was help her set up a volatility buffer where she only took her distributions of $1,000 a month in years when the market was up and not when the market was down? Now, we saw that. You guys saw it on the previous episode. We did that with $3 million at the beginning of retirement, and out about 25 years, the person who used a volatility buffer actually had $1 million more money, and I think could be argued took far less risk. Mm-hmm. Well, this person, what they wrote here is true in a vacuum. You know, by the way, what if the investment advisor that at some point there was volatility, and that investment advisor was Corey, and he had a conversation with this client where he came alongside her, and in 2020, at the depths of COVID, she didn't sell her portfolio. Now what's the impact? And I think you carry a similar down to the next one, Corey, which is Jim is 26 years old, saved $30,000 after 4 years in the workforce. He rolls over the account during a job switch, moving from a 401k plan, charging 0.9%. So pause there. Like, a little bit of a difference, right, Corey, between these two 401ks.
Right.
That even the 401ks can have a big difference in fees. 0.9 to one charging 1.24. Now they're going to assume an 8% rate of return for this 40 years for the 26-year-old. And what they show is you'd have $443,333 or $507,980. So a total difference of like 63-ish thousand, 64.
Also, I just realized something about Sarah. She has a drawdown. They're estimating a drawdown of $1,000 per month from her account. Well, if she does $1,000 a month from age 65 to 72, at 72, her RMD is still lower than that. But if she continues that $1,000 a month till age 85, her RMD is now $1,500 a month. A little under that. It's about $15,000 a year, so more than 12 grand. So, like, did the advisor help her manage required minimum distributions? Maybe have some kind of strategy to convert over to Roth over time to minimize having to take out that extra amount of money. She'd actually have less at age 90 than $123,000 because of those RMDs. Mm-hmm. So it's like, if you can do it yourself, if you're handy with a hammer and you don't need to hire a contractor and you're happy with the result and you're getting at or better than market standard all by yourself, then no, you shouldn't pay higher fees. Maybe. But if you need that help and want that help, then that's what's getting missed in this whole equation.
I'll give you one. So let's look at our next person where it looks like a $64,000 difference over this 40-some years. Here's the bottom line. That $60-some thousand difference over 40-some years, that's like $1,500 a year of value. I don't think you should have a financial advisor if they're not bringing you at least $1,500 of value a year. Like, that's a pretty small hurdle to clear, number one. Number two, one time over that entire 40-year period that the client was talked off the cliff when they're about to sell their entire portfolio, say at the depths of COVID, or at the worst part of 2015, or at the worst part of 2011, or at the worst part of 2002. You get my drift. Like, there's a lot of these.
Right.
And
I mean, we have a process designed in a way that, like, if someone with that fact pattern came to us, we wouldn't even make them an offer to work together unless we were assessing that we were adding about 5 times that $1,200 a year in value.
Exactly. And other little things that a good coach advisor might have brought up is, hey, you should have a home equity line of credit on your house. You've done a lot of good work to build up this money in the 401k. We don't want to have to access it for a loan or something else that would disable its ability to grow for you. You should have X amount of money in cash to get you through rough times when they show up, not if. We should have the appropriate amounts of disability insurance and life. Like, you kind of get, there's a lot more, but you can see even the financial, I held on to that F-bomb, the financial French toast industry. A French toast will be my holder. You guys, just whatever your favorite curse word is, just throw it in every time I say French toast. These French toasting French toasters,
okay.
What they do is, even about our own industry, they boil it down to binary choices of you do this or you do this, without any, not even lip service, not even talking about it's a possibility, that there is a lot more that goes into our financial life than some dude that managed to pass a couple of tests is just managing our money and meeting with us twice a year going, here's what your money did. Like, somebody should be inquiring into what's happening in your life, what's important to you about the future, and then helping you set up your money to close gaps on those aims, period. This should not be an asset management or fee-based game by itself. If that's the game your advisor's playing, they've already lost it for you.
No one even buys fruit like this article talks about people buying investments. Like, you go to the store, it's one costs more, one costs less. That's not the end of the story. Like, is it right? How does it smell? Yeah. So when does an IRA rollover make sense is the next section. And so it's showing, like, so I do like this in one way that it's saying, okay, there are some situations where there could be value, but here's what really jumped out to me. The third bullet point down. A rollover also can make sense if your former employer isn't eager for you to stick around. Just 20% of plan sponsors actively encourage participants to keep their assets in the plan when they retire, according to an annual survey of workplace plans by the Plan Sponsor Council of America. So what this is saying is that 80% of the time, it's probably better to move your money because you're not getting any active support from that former employer. Like, it gets harder when you retire. So just this little bullet point in here, almost like that would be great context at the very beginning of the article, because it's like all of this kind of poo-pooing of rolling money, but then right there, just little bullet point, 80% of the time, it's probably better. They
don't want you there. And the very next bullet, like a huge amount of plans, only 63% of all plans allow you to take some kind of consistent distribution in retirement anyway.
Yeah, so if you don't roll it over, you're getting on the phone every month to request a distribution to get the money out to pay your rent. Like, no, it's not gonna make sense.
Well, and all that to say that also your employer set up, like, now we have an old saying at our firm that there are no employee benefits. they're only employer benefits. The employer is only giving you a benefit because ultimately it makes you a happier employee, it makes you more effective at the work you do or whatever. They're all employer benefits. It's just sometimes the employees like the employer benefits.
Right.
And they've added it as a benefit to satisfy and grow their employees. So you know why you don't get great support when you retire? They don't need to keep you up anymore. You're out. They don't need you. It's not like you're going to be like, those suckers on the 401k, I'm so happy with my employer, I'm leaving. You left already. Your bargaining chip's gone. So not only there's not much of a standard for them wanting to do that, but by the way, anybody listening to this will tell you how asinine this way of looking at things, which is not Morningstar. And I'm not digging on this advisor. If you rewound to when I was the early stages of my career and the only influence I had was from financial institutions, I'd have said the same stuff. So this is just the problem with the morass, like the common conversations that float around our industry. So ask your 401k person, like call the person with Fidelity that does your 401k and just ask them for investment advice. And no, they can't. Ask the HR person. Ask the person that comes out and does an enrollment. Now, we're able to give some advice because we're also registered investment advisors, independently so. But you'd be amazed how many people are in that 401k enrollment meeting with you and you say, well, what kind of portfolio should I have? And watch them tap dance. Yeah, they're going to be polite, all that, but regulators don't allow them to just give you advice because they don't know enough about you. And so it is really a lone wolf and do it on your own thing. And then last but not least, if you're a lone wolf and it's do your own thing and you feel confident in doing it, then you can end up in some pretty low fee situations managing it yourself, not in your 401k, which makes this whole article completely useless. Because if you know what you're doing and you can do it on your own, you sure as heck don't keep it in your 401k. Unless, I do have one caveat. Sorry, Corey. One caveat. And then I'm going to have you close us out because God bless it, the audience needs you to land this plane. But along with the fact that you could manage it on your own, you could do it in your own 401k, you can think through it on your own. Your employer has no interest in you being successful financially, and they can't give you advice to get that done. This is on you making your financial future happen. These rules and extra things they put in place come far too late. Because, by the way, most of the ethics of the industry since they started this regulation back in 2008 have massively changed. And yet the regulation is going to stand, which is why you need to be the one who's taking it in your court, that you're controlling it, that you're understanding your fees, that you're acting as your own fiduciary and making sure you know you want what you want out of the future. And if you need help being able to look at that big financial picture, then you got to find someone like Sound Financial. You can reach out to us, certainly, or find someone that looks at the world the way that we do. Because what they can do is make sure that your money's actually going to get you to where you want to go, not just result in a new transaction for some financial institution. Okay, Corey.
So I think if we could leave you with one word from this entire conversation, it would be the word value. A deep consideration of what is the total value you are getting out of the relationships that you have or the accounts that you have in your financial world. Because there are some very low cost investing options that have a high price at the end of the day because of what you are missing on the other side. And the cheapest account that was not the right account for you to begin with, that was not marching you down the road to the path that you wanted to go, is very expensive. So thanks for sticking with us. Please reach out to us if you have some questions about the value you're getting in your current relationship. Current clients of Sound Financial Group, this is where the industry is going. These regulations are maturing, and we're going to have some continued into showing the value that we provide and that we get out of the relationship. And we would never want anyone who wasn't continuing to get that value to stay with us. That's just not the kind of long-term relationship that serve anybody. So as always, love having you here, Sound Financial Group family, and we hope this has contributed to you being able to design and build a good life.
Don't forget to like and subscribe.